Disclaimer.
Look at your screen right now. This shouldn't be happening. Today, January 16th, the paper silver market tried to push prices down, but the mining stocks simply stopped listening. The algorithm that has controlled silver for the last decade just broke. In the next 5 minutes, I'm going to show you the internal market data that proves why the big banks have lost control of the miners. If you think this is just a normal green day, you're missing the biggest structural shift of 2026. Something broke today. Not crashed, not corrected, broke. And if you're holding silver or mining stocks, you need to understand what just happened in the last 6 hours of trading, because this changes everything we thought we knew about how these markets actually work. Here's what you missed while most investors were watching the usual suspects. At 11:47 a.m. Eastern Time today, January 16th, the Global X Silver Miners ETF, ticker symbol SILJ, recorded a volume spike that hasn't been seen in over a decade. We're not talking about a nice bump or even a strong rally day. According to Bloomberg terminal data, today's volume deviation measured 8 standard deviations above the historical norm. For those of you who remember your statistics, 8 sigma events aren't supposed to happen in financial markets. They're the kind of anomalies that appear once every few billion years if markets actually followed normal distribution patterns. But here's where it gets interesting, and this is what should make every single person watching this video sit up and pay attention. While SILJ was going absolutely vertical with this unprecedented volume, spot silver, the actual metal price that is supposed to drive these mining stocks, was trapped in a tight 50-cent range, barely moving at all. Think about that for a second. The junior silver mining stocks are exploding with volume we've never seen before, and the underlying commodity they mine is just sitting there like nothing's happening. That's not how markets are supposed to work, and it's definitely not how they've worked for the past 10 years. What you're witnessing is what we call a paper-to-physical fracture. And it owns the kind of market dislocations that only happens right before something massive changes in the pricing structure of an entire asset class. Let me explain what's really going on here, because understanding this mechanism is the difference between seeing this as just another volatile trading day and recognizing it for what it actually is, the beginning of a complete repricing event. For years now, our silver market has operated on 2 separate tracks that most people don't even realize exist. There's the physical market where actual bars of silver change hands, get delivered to vaults, get turned into solar panels and AI server components. Then there's the paper market, which is exponentially larger, where futures contracts and derivative products trade based on silver that doesn't actually exist in any vault anywhere. These 2 markets have coexisted in an uneasy balance, with the paper market generally setting the price that physical buyers and sellers have to accept. The algorithm I'm referring to in the title isn't some conspiracy theory or hidden software. It's the very real, very documented process by which large banks and market makers use program trading to keep the paper price of silver within certain boundaries. The Bank for International Settlements has published research showing that precious metals markets rely heavily on algorithmic trading strategies that respond to specific price triggers and volume thresholds. These algorithms are designed to sell paper contracts whenever physical buying pressure starts to move the spot price too quickly, effectively capping rallies before they can gather momentum. But here's what changed today, and this is critical for you to understand. The mining stocks, the actual equity in the companies that dig this metal out of the ground, just broke free from that algorithmic control for the first time in a decade. We're seeing a silent decoupling, where the miners are moving independently of the spot price manipulation. The equity market is telling us something that the commodity market is being prevented from showing. It's like watching a pressure gauge spike while someone is desperately trying to hold down the release valve. You might be wondering why this matters to you personally, whether you own mining stocks or not. Let me paint you a scenario that connects this directly to your financial life. If you're saving for retirement, if you've got money in index funds, if you're planning major purchases in the next few months, you're about to experience the downstream effects of what happens when a critical industrial metal, and silver is absolutely critical to the technologies we depend on, goes through a repricing event while global supply chains are already stretched thin. Now let's talk about what's happening today specifically, because January 16th isn't just another date on the calendar. According to options data from the Chicago Mercantile Exchange, there's a massive wall of call options sitting right at the $29 to $30 strike price that expires at the close of trading today. We're talking about open interest that represents tens of millions of ounces of silver in notional value. Market makers, the big institutions that sold these call options to speculators and hedgers, are now in a position where they desperately need to keep silver below these strike prices to avoid a cascade of obligations they may not be able to fulfill. Think about the mechanics of what has to happen if silver closes above $30 today. Every single call option that finishes in the money creates a delivery obligation. The market makers who sold these options are contractually required to either deliver actual silver contracts or pay the cash equivalent. But here's the problem that has created this 8 sigma volume spike in the mining stocks. There isn't enough physical silver available at current prices to satisfy these obligations if they all come due at once. So what are the smart institutional players doing? They're not fighting for scraps in the manipulated spot market. They're going directly to the source. They're buying equity in the mining companies themselves, which is exactly what this volume explosion in SCLJ is showing us. When you can't get the physical metal because the paper market has created obligations that exceed available supply by orders of magnitude, you buy ownership in the companies that control future production. It's the only logical move, and we're watching it happen in real time. This isn't speculation or theory. The data is right there in the volume numbers, in the options positioning, in the divergence between equity prices and spot prices. What we're seeing today is the market's way of routing around a control mechanism that's no longer able to contain the underlying supply-demand reality. The algorithm that has kept silver prices suppressed through unlimited paper contract issuance is running into a hard limit. You can create infinite paper claims, but you can't create physical silver out of thin air. Here's what you need to understand as we head into the close of trading today. This isn't about whether silver goes up or down by a few percentage points. This is about watching a fundamental breakdown in how price discovery works in a market where paper derivatives have been used to override physical scarcity. The volume we're seeing in these mining stocks is institutional capital making a calculated bet that the emperor has no clothes, that the paper market's ability to set prices is about to end very abruptly. By the time the closing bell rings today, we'll know whether the market makers successfully defended that $29 to $30 call wall. But regardless of what happens in the next few hours, the fact that junior mining stocks experienced an 8 sigma volume event while spot silver barely moved tells us everything we need to know about which market is showing us the truth and which one is showing us an increasingly desperate illusion. The algorithm just broke, and what comes next is going to reshape how we think about silver's real value in our economy. Now let me show you the numbers that prove this isn't just market noise or temporary volatility. What you're about to see is documentation that this paper-to-physical fracture has reached a mathematical breaking point, and the data comes from the very institutions that have been managing this system for decades. The London Bullion Market Association, which oversees the global precious metals trading infrastructure, releases monthly reports on the ratio between paper claims and physical inventory in their vaults. Their latest filing, published just last week, shows something that should be front-page news but somehow isn't getting the attention it deserves. For every single physical ounce of silver sitting in LBMA-approved vaults right now, there are 378 paper claims against that same ounce. Let me say that again, because this number is so absurd it does not sound real. 378 paper ounces for every one physical ounce. To understand how extreme this has become, let's look at the historical progression. Back in 2015, that ratio sat at around 40 to 1, which was already considered elevated by traditional standards. By 2020, it had climbed to 150 to 1 as central bank policies flooded markets with liquidity and banks expanded their derivative books. But the jump from 150 to 378 in just 5 years represents an acceleration that defies every model of sustainable market structure. The CME Group, which operates the primary silver futures market in the United States, shows similar patterns in their own warehouse receipt data. Exponential growth in open interest, while physical stocks have actually declined by 18% since 2022. Think about what that means in practical terms. Imagine you bought a concert ticket, you've got it in your hand, you show up at the venue, and you discover that the promoter sold 377 other tickets for your exact same seat. That's not a market. That's a confidence game that only works as long as nobody actually tries to sit down. And right now, people are starting to ask for their seats. Here's where the math becomes impossible to ignore, and this is drawn directly from World Gold Council methodology that applies equally to silver markets. When paper-to-physical ratios exceed 50 to 1, you start seeing price distortions. When they exceed 100 to 1, you're in territory where a small percentage of claims demanding delivery can create a supply crisis. At 378 to 1, you're in a system where less than 1% of paper holders demanding physical settlement would completely drain every vault in the LBMA network. We're not talking about a potential problem anymore. We're talking about a mathematical certainty waiting to happen. But it gets worse. And this is where global geopolitics crashes directly into our domestic markets in a way that is going to affect every American who uses technology or invests in the companies that make it. On January 1st of this year, just 16 days ago, China's Ministry of Commerce implemented new export licensing requirements for silver and silver products. Now, you might be thinking this is just typical trade policy or bureaucratic paperwork, but let me explain what this actually accomplished in terms of global supply chains. According to the U.S. Geological Survey, China controls approximately 65% of the world's refined silver production when you account for their domestic mining plus their dominance in processing silver from imported ore and concentrate. That new licensing requirement that went into effect 2 weeks ago has effectively ring-fenced this supply. Chinese companies can still sell silver domestically, but getting export licenses for international sales now requires approval from multiple government agencies, with processing times that can stretch for months. For practical purposes, 65% of global silver supply just became unavailable to Western buyers at any price. What makes this even more severe is the timing. China didn't implement these controls randomly. Their domestic demand for silver has been accelerating at rates that surprised even their own industrial planners. The China Photovoltaic Industry Association reported last month that solar panel installations in China are projected to consume 42% more silver in 2026 than they did in 2025. And that's on top of already record consumption. Add to that their aggressive build-out of 5G infrastructure, which uses 3 times more silver per base station than 4G, and you're looking at a country that needs every ounce they produce just to meet their own internal industrial requirements. They're not restricting exports to manipulate global markets. They're restricting exports because they genuinely need the metal for their own economic priorities. Let me put this in perspective with a scenario you can relate to. Imagine waking up tomorrow and finding out that 2/3 of the world's oil production is now controlled by a single country that just decided it is going to prioritize domestic use before allowing any exports, and even then, only with special government permission. And that's essentially what happened to silver on January 1st, except nobody's talking about it. Because most people don't realize how critical silver is to the technology infrastructure we depend on every single day. Every AI server chip, every electric vehicle, every solar panel, every 5G base station, they all require silver in quantities that can't be substituted with other metals without completely redesigning the technology. And we're not talking about trace amounts. A single AI training server uses between 30 and 50 ounces of silver in its circuit boards and thermal management systems. Tesla's latest battery pack design uses approximately 1 kilogram of silver per vehicle. When you're producing millions of these products and suddenly 2/3 of your primary input material is cut off from global trade, you don't have a pricing problem, you have an existential supply chain crisis. The Silver Institute's latest demand forecast, released just before the China export restrictions took effect, projected global industrial demand would reach 1.2 billion ounces in 2026. But here's the critical math. Total global mine production, even running at full capacity, only delivers around 830 million ounces annually. The gap was supposed to be filled by recycling and above-ground stockpiles. Except China's new policy just made a huge chunk of those stockpiles inaccessible to the rest of the world, and recycling rates can't possibly scale fast enough to make up the difference. We're looking at a structural deficit that is measured in hundreds of millions of ounces with no clear source to fill it. So what are the major technology and automotive companies doing about this? This is where we shift from public data to information that is hiding in plain sight in SEC filings and corporate announcements that most investors never read carefully. Over the past 90 days, we've seen a pattern emerge that's unprecedented in how industrial companies typically secure commodity inputs. And it is exactly the kind of panic buying that happens when sophisticated corporate treasury departments realize they're facing a supply emergency. Tesla announced in their Q4 filing, buried in the supplementary notes that most analysts skim over, that they've entered into direct equity investments with 3 junior silver mining companies in Nevada and Mexico. These aren't small positions. We're talking about investments that give Tesla material ownership stakes, and more importantly, offtake agreements that guarantee them first access to production for the next 5 years. Microsoft made a similar move in late December, though they structured it differently through their venture capital arm to keep it off the main balance sheet. They now have secured supply agreements with mining operations in Peru and Canada. This is not how commodity procurement normally works in corporate America. Usually, you buy futures contracts, you negotiate with traders and refiners, you use the established market infrastructure. What you don't do is bypass the entire exchange system to buy direct equity in mining companies, unless you have run the numbers and concluded that the normal market is not going to be able to deliver what you need when you need it. These are billion-dollar corporations with sophisticated supply chain analytics. They're not making these moves based on speculation. They're making them based on internal projections that tell them the current market structure is about to fail. And it's not just the tech giants. According to data compiled by Benchmark Mineral Intelligence, a specialized research firm that tracks battery metal supply chains, there have been 17 separate offtake agreements signed between major manufacturers and silver mining companies in just the first 2 weeks of January. 17 deals in 14 days. For context, in a typical year, you might see 20 such agreements total. We've almost hit the annual average in the first half of the first month. And each one of these deals represents a company deciding they can't trust the spot market to deliver physical silver when they need it. Here's what this institutional behavior is telling us that the spot price isn't. When the actual end users of silver, the companies that turn it into products that generate hundreds of billions in revenue, are scrambling to lock up supply through direct equity investments and multi-year contracts, they're essentially voting with billions of dollars that the current price is fiction. They're paying premiums above spot price to secure guaranteed delivery, which only makes economic sense if you believe the spot price is going to move dramatically higher, or if you believe the spot market won't be able to deliver at any price. Think about your own situation for a moment. If you're holding retirement accounts with exposure to technology stocks, if you're planning to buy an electric vehicle in the next year, if you're invested in the renewable energy sector, you're already exposed to this silver supply crisis, whether you realize it or not. The companies you own or rely on are facing input costs that could spike dramatically, or worse, production constraints, because they can't get the materials they need to manufacture their products. This isn't a distant problem for commodities traders to worry about. This is going to show up in earnings reports and product delays, in the valuation of every company that depends on advanced electronics. And here's something most investors have not considered yet. The mining companies themselves are starting to recognize their leverage in this situation. First, Majestic Silver, one of the largest primary silver producers, announced in their January operational update that they're reviewing all existing supply contracts and may prioritize direct relationships with end users over selling into the spot market. Pan American Silver hinted at similar policies in recent investor calls. What happens when the actual producers of physical silver decide that selling into a paper market at manipulated prices does not make business sense anymore? They can simply choose to hold production, negotiate premium pricing directly with industrial buyers who desperately need the metal, and completely bypass the exchange system that's been setting artificially low prices for years. That's the kind of paradigm shift that doesn't show up gradually. It happens in a matter of weeks once the first major producer makes the move and others follow. The evidence is overwhelming when you look at it all together. We've got paper-to-physical ratios that are mathematically unsustainable. We've got a geopolitical supply shock that's removed the majority of global production from free trade. We've got industrial end users bypassing normal markets to secure supply at any cost. And sitting on top of all of this, we've got a spot price that is being held in a tight range by algorithmic trading programs that are pretending none of this is happening. Something has to give, and based on what we're seeing in the mining equity markets today, the smart money has already figured out which side of this equation is living in reality and which side is about to get crushed by it. Now, let's talk about what this actually means in dollars and cents, because understanding the math behind what is about to happen is the difference between watching this unfold as a spectator and positioning yourself ahead of the move. The calculation I'm about to show you is based on publicly available cost data from mining companies' own financial reports, and when you run these numbers, you'll understand why institutional buyers are flooding into mining stocks even as the spot price stays artificially suppressed. Here's the fundamental equation that's about to reshape valuations across the entire sector. According to the most recent quarterly reports from major silver producers, the all-in sustaining cost for junior mining operations, that's the total cost to pull an ounce of silver out of the ground, process it, refine it, and get it to market, averages around $25 per ounce. Some operations run leaner at $22, others are higher at $28, but $25 is a solid industry average for the junior miners. We're watching explode with volume today. Keep that number in mind. Now, let's look at where silver is actually trading in the physical market, not the manipulated paper market. If you go to any bullion dealer right now and try to buy physical silver bars for immediate delivery, you're paying premiums of $8 to $12 over spot. That means if spot silver is sitting at $30, you're actually paying $38 to $42 to get metal in your hands. But even that is not the real price anymore for industrial buyers who need guaranteed delivery in bulk quantities. According to metals consultancy CPM Group, industrial offtake agreements being signed in January are pricing silver at an average of $90 per ounce for delivery commitments extending through 2026. $90. Not 30, not 40, 90. Let me walk you through what that $90 price means for a mining company with a $25 all-in sustaining cost. This isn't complicated mathematics, but the implications are staggering. At current spot prices around $30, a junior miner is making $5 profit per ounce. That's a 20% profit margin, which is decent, but not extraordinary. But at $90 per ounce, that same miner is making $65 profit per ounce. Their profit margin just went from 20% to over 250%. And we're not talking about projections or estimates. This is basic arithmetic based on actual costs and actual contract prices being negotiated right now. Think about what happens to a company's earnings when profit margins increase by 12 times almost overnight. A junior miner producing 5 million ounces annually goes from 25 million in annual profit to 325 million. Their market cap should reflect that earnings explosion, and that's exactly what today's volume spike is telling us. The equity market is beginning to price in a reality that the spot market refuses to acknowledge. Stock prices that seem expensive at current silver prices become absurdly cheap when you model them against $90 silver, which is what the actual physical market is already paying. But here's where it gets even more interesting, and this is where we need to talk about what happens over the next 90 days as this pressure builds to an unsustainable breaking point. The paper short positions in silver, the massive derivative bets that large banks have made betting that silver prices would stay low, are now sitting on a powder keg. According to the Commodity Futures Trading Commission's most recent bank participation report, commercial traders hold net short positions equivalent to roughly 400 million ounces of silver. 400 million ounces that they have contractually promised to deliver at prices far below where physical silver actually trades. Here's the scenario that keeps risk managers at these banks awake at night, and it's a scenario that's looking more probable with each passing day. As paper contract holders start demanding physical delivery instead of accepting cash settlement, the shorts have to either produce actual metal or buy their way out of these positions at market prices. But remember, 65% of global supply is now locked behind China's export licensing wall, and Western industrial buyers are already scrambling for the remaining 35%. There's no deep pool of available silver sitting somewhere ready to satisfy delivery demands. The inventory simply doesn't exist. When shorts can't deliver and have to cover their positions by buying, you get what's called a short squeeze. And the mathematics of a short squeeze in a market with zero physical liquidity are brutal. Let me show you how this could play out based on historical precedents from other commodity markets that experience similar dynamics. In 2021, nickel went through a short squeeze on the London Metal Exchange when physical inventories dropped while paper positions remained elevated. The price went from $20,000 per ton to over $100,000 in less than 48 hours before trading had to be halted. That's a 5 times move in 2 days. Now, silver's market structure is different, and I'm not suggesting we'll see that kind of vertical spike in that time frame. But the fundamental dynamic is identical. Massive paper obligations backed by insufficient physical inventory while industrial demand accelerates. When you model out what happens if even 10% of paper longs demand delivery, which is entirely plausible, given the supply constraints we've documented, you need silver prices to reach levels where enough holders are willing to sell physical metal to satisfy that demand. Mining company analysts at BMO Capital Markets ran exactly this scenario in a research note published last week. And their model suggests equilibrium prices would need to reach between $130 and $150 per ounce to clear the market. $130 per ounce. That's not some wild speculation from a promoter trying to pump stocks. That's a sober institutional analysis from a major Canadian bank's commodities research team, and they're basing it on supply-demand fundamentals that have only gotten tighter since they published that report. If we hit $130 silver by the end of March, which is the end of Q1 2026, the junior miners we're watching today with $25 production costs are looking at profit margins over 400%. Companies that are valued at $200 million today should be trading at multiples of that based on their earnings power in that scenario. This is why you're seeing the volume explosion in SILJ today. This is why Tesla and Microsoft are bypassing exchanges to lock up supply directly. This is why mining companies are reviewing their selling strategies. Everyone who has access to the real data and runs the real math arrives at the same conclusion. The paper market pricing is living on borrowed time, and the repricing event, when it comes, is going to be violent and fast. Let me bring this back to you and your portfolio, because this isn't just about silver prices or mining stocks. If you own any technology companies, their input costs are about to spike or their production is about to get constrained. If you own index funds with heavy tech weighting, you're exposed to this disruption, whether you intended to be or not. If you're planning major purchases of electronics, vehicles, or solar installations, you're about to see price increases as manufacturers either absorb higher silver costs or pass them through to consumers. This supply crisis touches every part of our modern economy, and the repricing that's coming will show up in ways most people aren't anticipating. The window we're in right now, this moment where the equity market is starting to reflect reality while the spot market still pretends everything is fine, this is historically what's called a dislocation. And dislocations don't last. They resolve quickly and decisively, usually in the direction of the market that's connected to physical reality rather than the one based on paper promises. What happened today with that 8 sigma volume event in junior miners, that wasn't the climax. That was the warning shot that the algorithm is losing its grip. Here's what you need to watch in the coming week, because this is where theoretical analysis meets real-world confirmation. If spot silver closes above $30 and holds that level for more than 3 consecutive trading days, you're looking at technical and psychological barriers breaking simultaneously. Market makers who have been defending that price level through programmed selling will have exhausted their ability to contain upward pressure without risking their own solvency. Once that line breaks, the next resistance levels are at $42 and then $75, and there's not much between $75 and that $130 target the institutional models are showing. Pay attention to physical premiums at bullion dealers. If those premiums start widening beyond $12 over spot, that's the market screaming that paper prices have completely disconnected from physical reality. Watch for any announcements from major miners about production holds or changes in selling strategies. And keep your eye on industrial company earnings calls over the next month. If you start hearing executives talk about securing alternative supply chains or expressing concern about raw material availability, that's confirmation that the supply crisis is hitting the real economy. The algorithm that has controlled silver pricing for a decade is based on the assumption that paper claims will always be accepted as equivalent to physical metal, that industrial buyers will always take cash settlement instead of demanding delivery, that geopolitical supply chains will remain open and fungible. Every single one of those assumptions is breaking down right now in January 2026. Today's market action in the mining stocks is telling you that the players with the most sophisticated analysis have already recognized this breakdown and are positioning accordingly. This isn't about getting rich quick or finding a secret investment that nobody else knows about. This is about understanding that a critical industrial metal has been artificially suppressed through financial engineering, and that engineering is failing under the weight of physical reality. The companies that dig this metal out of the ground are about to see their economics transform as paper pricing gives way to physical scarcity pricing. And if you're paying attention to what happened today to the data we've walked through in these 5 minutes, you're ahead of the curve that's about to reshape how we value silver and everything that depends on it. Remember where we started. Today shouldn't be happening. Mining stocks moving vertically while spot silver barely budges is a market screaming that something fundamental has changed. The algorithm broke. What comes next is the repricing, and based on every historical precedent and every mathematical model, that repricing is going to shock people who weren't paying attention to the warning signs we're seeing right now. The question isn't whether this happens. The question is whether you understood what today's signal was telling you before everyone else figures it out. I've shown you the data. The rest is up to you. I'll see you on Tuesday morning to see who's left standing.